Right now, silver is caught in a tightening vice, and that vice is macroeconomic pressure, most critically, the strength of the U.S. dollar combined with sticky interest rates. These are not trivial headwinds. They strike at silver's dual identity as both an industrial metal and a quasi-monetary asset. When monetary policy leans hawkish, silver simply doesn't get to shine as brightly as it might in a looser world. At its essence, silver doesn't pay interest. It's a non-yielding asset. That means when the U.S. Federal Reserve pivots toward higher rates, it elevates the opportunity cost of owning silver. Investors can lock into bonds or fixed income instruments that generate yield. Why hold a shiny metal that just sits? As real yields climb, capital starts flowing out of non-yielding stores of value. This shift is especially acute for precious metals, and silver takes a double hit. Not only is it being displaced, but it's increasingly unattractive versus cash-generating options. Accounting Insights +3, Alibaba +3, Seat, all digital solutions +3 at the same time. The U.S. dollar itself has strengthened, and that's been a silent but lethal force for silver. Since silver is denominated in dollars on global markets, a rising dollar makes it more expensive for investors and industrial consumers outside the U.S. Swiss bullion. EU+1. A stronger dollar means less buying power abroad, crushing both physical demand and speculative flows. As the greenback climbs, demand from foreign buyers shrinks, and silver feels that squeeze immediately. But it's not just the stronger dollar. It's the narrative that comes with it. When interest rates remain high or when the market fears that central banks will not cut soon, it reinforces confidence in the dollar's dominance. Capital flows into U.S. treasuries, reinforcing the dollar's strength further. This is a self-reinforcing cycle. Financial content for silver. This isn't a backdrop of disinterest, it's active displacement. Layer on top of that the hawkish signals from central bankers. The Federal Reserve has been cautious, indicating that cuts may be more gradual than some investors hoped. Financial content. That caution weighs on investor psychology. If rates stay elevated, silver loses one of its most compelling use cases as a hedge or inflation play because more capital becomes tied up in rate-bearing assets. What's important to grasp is that these macro pressures aren't just about interest rates or a strong dollar in isolation. They're about how both feed into capital flows and shift risk profiles. When the dollar is strong, emerging markets and non-dollar economies feel the pinch. Industrial buyers made up a significant portion of silver demand: electronics, photovoltaics, advanced tech, but a more expensive dollar makes imports costlier. That erodes demand precisely when silver was gaining a narrative-driven tailwind. Swiss bullion. EU beyond immediate supply demand imbalance. Silver's near-term future is being reshaped by capital reallocation. Institutional money, hedge funds, and global investors are watching the macro carefully. Every hawkish Fed communication or resilient U.S. economic data point can trigger flow out of precious metals. We're not just seeing technical trading or short-term profit taking. We're seeing a fundamental shift in how capital is being distributed, and silver is bearing the brunt. In this environment, silver becomes more volatile and more sensitive to macroeconomic messaging. It's not enough for industrial demand to remain strong in the long run. The short-term investor needs clarity on interest rates, and they need confidence in the dollar's direction. Without that, silver is less of a portfolio anchor and more of a speculative play. And right now, macro forces are overwhelming much of its upside. There's an irony unfolding in the silver market. Even as industrial demand has hit record highs, the momentum is beginning to slacken. Back in 2024, industrial silver fabrication reached 685 million ounces, driven by strong gains in electronics, photovoltaics, automotive, and green grid infrastructure. The Silver Institute +1, but that very strength may now be running into headwinds. The pace of this growth is slowing, and the forces behind it deserve careful scrutiny because a structural story doesn't always mean linear acceleration. One of the biggest stress points is in solar manufacturing. Solar photovoltaic demand has been a cornerstone for silver's industrial use, but module overcapacity, especially in China, is forcing producers to push back. Second Financial. Com+2 Second Financial. Com+2 As silver prices rose, manufacturers responded by thrifting, optimizing their designs to use less silver per solar cell. Over 2024, loadings per cell dropped significantly, and further reductions of 10–12% are projected for 2025. Second Financial. Com that means even as solar capacity expands, silver demand from that sector may flatten or even decline unless installations surge aggressively. Trade uncertainty makes things more fragile. Tariffs, geopolitical tensions, and supply chain unpredictability are weighing on solar project rollouts, particularly in key exporting and importing regions. Second Financial. Com when solar developers defer or delay projects, silver consumption is directly hit. These delays aren't just one-off hiccups. They feed into a larger hesitancy that ripples across industrial planning. The risk is that silver demand from green energy infrastructure could underperform relative to prior expectations. Meanwhile, the broader tech demand is showing signs of moderation. Yes, electronics remain a key pillar. Semiconductors, PCBs, IoT devices, data centers. Silver's conductivity is irreplaceable. In 2024, silver used in electrical and electronic manufacturing remained strong. The Silver Institute, but growth is slowing. The latest forecasts suggest just a 1% increase this year in electronics demand, reflecting a more cautious environment for end markets like consumer devices, EVs, and AI hardware. The Silver Institute, in short, the green tech silver supercycle, may be real, but the near-term sprint appears to be turning into a more measured marathon. At the same time, substitution risk is not going away. As silver prices stay elevated, manufacturers are incentivized to find alternatives or at least use less silver per unit. The fact that loadings are already being reduced in PV means this is not a distant threat, it is happening. Second Financial. Com over time, if silver becomes too expensive a component for some industrial users, we could see more aggressive moves towards substitution or enhanced recycling. That kind of demand discipline could sap some of silver's upside, even if the long-term demand thesis remains intact. Another layer complicating things. Industrial demand is being weighed down regionally. According to recent data, while China's industrial silver offtake grew, Western demand, especially in the U.S., and Europe is soft with the U.S. Industrial silver demand reportedly falling in 2024. The Silver Institute. This divergence matters. Industrial demand is not a monolith, and slower growth in mature markets could dampen the global aggregate. Even as demand slows, supply-demand dynamics remain tight, but this is becoming a story of nuance, not runaway momentum. Analysts at Metals Focus and S&P Global point to a persistent structural deficit, but they also note that thrifting continues in the photovoltaic sector. S&P Global, that means while demand is strong, efficiency and cost management by manufacturers could blunt some of the silver consumption pressure. From a strategic perspective, this is precisely the kind of inflection point that the most visionary investors love to find. One must distinguish between secular demand drivers, green energy, AI, electrification, and cyclical or transitional softness. Yes, global manufacturing may be cooling, and yes, silver loadings are coming down, but the underlying relevance of silver in technology infrastructure remains profound. The real question now is not whether industrial demand will return, but how big that rebound could be, and whether the current weakness is an opportunity to position ahead of a structural shift. Silver's supply landscape is quietly shifting beneath the headlines, and we are entering a phase of meaningful rebalancing, not collapse, but adjustment. Mine production, for instance, is on the rise again. According to the 2025 World Silver Survey, global silver mine output increased by about 0.9% in 2024 to reach 819.7 million ounces. The Silver Institute plus two key contributors include Mexico, where the Penasquito mine ramped back up, and significant boosts also came from the U.S., Australia, and Bolivia. The Silver Institute, moreover, silver production linked to gold mines surged strongly, up 12%, intensifying the flow of byproduct silver. The Silver Institute, but it's not just primary production that's improving. Recycling is stepping up in a big way. In 2024, recycled silver climbed by 6% to 193.9 million ounces, the highest in 12 years. The Silver Institute plus one, much of that comes from industrial scrap, particularly from spent ethylene oxide catalysts used in various chemical processes. The Silver Institute plus one, and this isn't a one-off, recycling is projected to rise further in 2025, potentially crossing 200 million ounces. Afroswiss Commodities. Com plus one, this dual boost in both mine production and recycled output is helping to ease some of the previously tight physical dynamics. London Vault Holdings LBMA are showing inflows. Per the Q2 2025 LBMA report, silver in London vaults rose by 4.08%. LBMA that suggests a growing reservoir of physical silver, which tempers the kind of acute supply stress that comes with scarce vault inventory. At the same time, on-the-ground operations are being optimized. Some mining companies are intensifying their silver recovery techniques, squeezing more silver out of ore that previously barely paid its way. This push is not trivial. Given that a big portion of silver comes as a byproduct, miners are increasingly committed to extracting silver more efficiently because the economics justify the effort in today's market. Discovery alert, yet this supply rebound is not uniform or unlimited. While primary output is growing, base metal mines, long a major source for silver, are not necessarily scaling up in tandem, because prices for base metals remain under pressure. Afroswiss Commodities. Com that limits how responsive silver production can be to rising silver prices alone. Supply elasticity is constrained by the economics of the host metals. Meanwhile, even though supply is improving, the market is not returning to surplus. Analysts continue to project a sizable deficit. Minstead Gold. Com plus two Discovery Alert plus two HSBC, for example, expects the silver market to remain in structural deficit. Reuters, in other words, supply is catching up but not catching up fully. And that's actually a powerful signal. The market isn't breaking. It's recalibrating in response to both demand cycles and supply realities. This rebalancing matters for three critical reasons. First, it provides a more stable foundation for the supply side. Instead of being hostage to wild shortages, the market is building buffers and resilience. Second, it gives industrial consumers more predictability. If recycled supply continues to scale, that could smooth out some of the volatility associated with fluctuating mine production. Third, for long-term investors, this is not a liquidation event. It's a moment to assess where physical supply is going, where it's coming from, and how it fits into the broader structural demand story. From a strategic standpoint, this is exactly where high-conviction investing shines. The rebalancing phase is not the end of the story, it's the transition. The very infrastructure that is driving silver's long-term relevance, solar, EVs, AI applications, still depends on it. And with supply becoming more efficient and more diversified, the risk is shifting from a supply shortage to one of allocation and positioning. That asymmetry can create real opportunity. The silver market is never a static entity. Even as structural fundamentals remain compelling, it is equally shaped by the psychology of participants, and nowhere is this more visible than in profit-taking behavior and the volatility it generates. Following a remarkable rally that pushed silver prices to multi-year highs, investors who had ridden the wave are now making strategic decisions to crystallize gains. This is not mere panic. It is rational behavior in a highly liquid, globally traded market. Profit-taking occurs across multiple layers: retail investors, hedge funds, ETFs, and industrial players alike. Each layer adds to the dynamic, amplifying short-term swings and creating what we observe as volatility. After a meteoric rise, silver's ascent prompted a natural reevaluation. Investors who entered positions at $24, $28 per ounce suddenly found themselves holding assets valued at $50, $54. The temptation to monetize these gains is overwhelming. When profits are realized, these assets are sold back into the market, and even small-scale sell-offs can trigger chain reactions in automated trading systems. Stop-loss orders, algorithmic trading, and momentum-driven strategies magnify what would otherwise be incremental moves. The result is sudden, sharp price corrections that appear dramatic, even if underlying fundamentals remain intact. Economic times. This cycle of profit-taking is compounded by market sentiment. When volatility rises, fear and caution become contagious. Traders often anticipate further declines and move preemptively, selling positions even before reaching target price points. These anticipatory actions feed on themselves, creating rapid downward movements. Yet it's crucial to recognize that these swings do not necessarily reflect a change in silver's intrinsic value or its industrial and monetary importance. Instead, they are a natural response to market mechanics interacting with human psychology. Trade Forex. AI volatility also reveals a fascinating interplay between short-term trading and long-term structural trends. While speculative capital flows out during corrections, industrial demand remains persistent. Silver is a cornerstone of electronics, photovoltaics, medical technologies, and other high-growth sectors. These end uses are not subject to the whims of daily market sentiment. The divergence between short-term speculative movements and sustained industrial demand is critical. Savvy investors recognize that volatility creates opportunity. The very moments when the market overreacts to profit-taking often represent points of strategic accumulation for those focused on long-term structural growth. Silver Institute. Technical factors intensify the volatility cycle. Momentum traders often rely on signals such as moving averages, relative strength indexes, and support/resistance thresholds. When silver breaches key technical points due to profit-taking, these systems automatically trigger additional sales, which further accelerates price movement. While the headlines emphasize declines, underlying liquidity and market depth often remain robust. This is a subtle but important distinction. Volatility is not synonymous with weakness. It is an expression of the market seeking equilibrium. Trade Forex. AI, geopolitical, and macroeconomic news can also exacerbate short-term swings. Even minor shifts in interest rate expectations, currency strength, or industrial output data can trigger rapid adjustments in investor positioning. Profit-taking serves as the catalyst that magnifies these adjustments into visible volatility. The market reacts not only to new information, but also to the interaction between realized gains, risk management protocols, and forward-looking expectations. The net effect is a market that can move swiftly, sometimes erratically, even while long-term demand and structural trends continue to strengthen. In this environment, volatility is not a deterrent but a lens through which opportunity is revealed. It rewards discipline, research, and patience, recognizing the difference between transient profit-taking swings and persistent structural shifts allows investors to position strategically. Silver may experience sharp declines or sudden spikes in the near term, but for those who focus on industrial relevance, supply dynamics, and technological integration, These fluctuations are part of a rhythm that ultimately reinforces the metal's long-term significance. Profit-taking and market volatility are, in essence, two sides of the same coin. One reflects human behavior, the other is a mirror for opportunity. Understanding both is central to navigating the silver market intelligently, and those who do can leverage short-term turbulence to strengthen long-term positioning.